Okay, well, here we are at the last chapter in the entire textbook, the chapter 24. This has to do with capital budgeting and making investments, analyzing the returns on proposed investments, and trying to determine either whether we should invest in a project or a piece of equipment or a new store, something like that, or maybe we have alternatives of what to do with maybe a piece of land. Could be at Disneyland. They have 6 different attractions they can actually put on one plot of land. So we need to analyze all 6 of them to see which one would be most profitable. And that's what we're talking about: capital budgeting, investing in projects and investments to determine which one would be more profitable. Now we're going to look at 4 different methods for evaluating alternatives, and I foresee this chapter being broken down into 2 videos, because the chapter is broken down into really 2 sections. There's the non-present value methods, and then there's present value methods. And what present value means is taking into account the time value of money. And I know that that's maybe a new concept to a lot of you. Some of you might have already had some classes where they've introduced that concept. But the time value of money is a very important concept too, that at some point, and hopefully maybe in several classes, that you'll have an opportunity to work with it, because it has implications all through the accounting profession, actually through the business world. So anyway, I'm glad that we have an opportunity to work with it. That'll be the second video, working with these present value methods. Right now we're going to work with non-present value methods, just taking a look at straight cash flows, just straight up cash flows. So I'm going to shoot forward here a little bit, and capital budgeting. What exactly is capital budgeting? Well, it is the process of analyzing alternative investments and deciding which one to invest our funds in. Which one should we do? The process, of course, is to different people may submit proposals, or we will submit a proposal, but the person making the decision will have alternatives as to what to invest in. We're going to need to figure out how to evaluate those proposals, and that's what this chapter is about. And then based on those evaluations, we're going to choose one, and we're going to maybe approve one or reject it, as the case may be. Let's see. We make an initial investment in something. We're going to use it for a while. It's going to generate revenues. We're going to depreciate it, and then we're going to sell it, get rid of it. So I just want to know, during that process, is it going to be worth it to me? Is it going to be profitable, basically? So now the 2 methods that we're going to talk about in evaluating a project is one, the payback period, also known as the cash payback period, and I'm used to calling it the cash payback period, even though they just call it the payback period. So, but that's in fact what it is. And the second one will be the accounting rate of return. So let's talk about the payback period. And the payback period is the period of time. How long will it take before I get my money back? How long will it take? But before we discuss this, let's talk about cash flows. Cash flows. When we invest in a project, we're going it's going to take time for those returns to come back to me, and if those returns are even amounts at equal intervals, then that's called an annuity. And an annuity makes computations much simpler. But so the payback, the amount that I'm going to get back on a project, could be an even cash flow, which is an annuity, or it could be uneven. So I'm going to set this up and show it as I would in class, and show it, illustrate it so we can see the cash flows here. Now, the decision I have to make before me is whether to invest in a particular project or not. And here's the proposal. Here's what they tell us is going to happen. I'm going to invest $50,000 into a project, and this project, it should last for 5 years. 1, 2, 3, 4, 5 years. And what I'm going to get back on this project each and every year is $20,000. So you can see this is going to be a profitable project. I'm going to get back $100,000 for my initial investment of 50. So, and in all these examples, I'm going to use green for cash coming back in. That's incoming cash. And initial investment is the cash outflow, and the initial investment is always a negative amount. Now, the cash payback, or the payback method, it's a very simple computation, and it's really used as a screening, and we're going to see why. It has some drawbacks, but let's see how it works first, and then we'll talk about the drawbacks. If I invest $50,000 right now, the concern is this: the longer it takes for me to get back my $50,000, the more risky the project is. Because the longer it takes, the longer I have to wait to get a project, to get my money back, the less uncertain we will be. And that's what this method is all based on, is that the further I go out into the future, the less certainty there is. And I think we know that to be true. For example, if in today's environment of the COVID-19, nothing surprises me anymore. But notwithstanding that, if I were to ask you, can you tell me? Of course, you could go tell me what the price of gasoline is right now today. Do you think you could tell me with certainty what it'll be on Tuesday? What the price of gasoline, about what it'll be on Tuesday? And the answer is yeah, you could. If it's right now, if it's $3.10 a gallon, on Tuesday it's probably going to be around $3.10 a gallon. Could you tell me what the price will be next week, plus or minus 50 cents? Yeah, I think you could. It's probably going to be around anywhere from $3 to $3.50. Yeah. Could you tell me what it's going to be next month? You can see now we're starting to say, well, I don't imagine it's going to change a whole lot in a month. It's probably going to be around somewhere around $3 to $3.50. How about next year? Ooh, that I'm not sure about. How about in 10 years from now? You know what? I can't tell you what the price of gas is going to be 10 years from now. So the further we go out, the less certain we are. So the faster I can get my money back, the less risky it is. So now looking at this, how long before I get my $50,000 back? Well, if you do the math, you'll see that in year 1 I get 20. In year 2 I get 20. So by the end of year 2 I'll have 40,000. And looks like I have to go to the middle of the 3rd year. You see that? 20, 40, and then half of this year. I need to get halfway through this year, get half of that 20,000. So it's about 2.5 years. Well, the formula is this. It's just your initial investment, initial investment, and this, if this is an annuity, and you see this is annuity, it's the same amount every year at equal intervals. So you divide the initial investment by the annual cash flow. $50,000 divided by $20,000 per year, if you do it on a calculator, 2.5. I need 2.5 years to get my money back. That's the payback period. So is that good or bad? Well, it depends on what the company considers risky. They may not even evaluate a project unless it initially passes the payback period, and they may not consider a project if the payback period is more than 2 years. And if it's more than 2 years, in this case, they'd reject this project. Maybe they're in an industry that's changing so quickly that any projects that they invest in, they want to get their initial money back within 2 years. But if it's within 3 years, well, then this is an acceptable project. So that's how that works. Let's do another one real quick, just to get used to this. Okay. I am going to invest $100,000. And what I'm going to get back every year is $30,000. Recognize this to be an annuity. So what is the cash payback period? How long do I have to wait before I get my $100,000 back? Initial investment divided by the annual cash flow looks like 3.33 is what it comes out to. That's 3.33 years. I need 3.3 of these. And that's what it is. 3 1/3 years puts me at about right here. 30, 30, 30, and 1/3 of this year is $100,000. So that's how that would work. With an annuity, you simply divide the initial investment by the annual cash flow, and that tells you how many years it'll take. That is the cash payback period. That's how long it'll take me to get paid back. So now, what about uneven cash flows? What happens if that's the case? So I'm going to take another one and set it up here. Each of these are years. Initial investment, $40,000. We anticipate it's going to take a little time for this thing to get going. So first year I'm going to get $10,000. Next year I'm going to get $25,000. The following year I'm going to get, I'll say $30,000. And then after that I'm going to get $15,000, and maybe that's where it'll fizzle out. So this is going to be a 4-year project, and we can see that it's going to have about $80,000 cash flow. But initially, I just want to know, how long do I have to wait before I get my $40,000 back? What is the cash payback period? Well, because this is not an annuity, because it is an uneven cash flow, we have a little bit more work to do. And it's really a 2-step process. The first step is this. Find out which year you actually cross over and get your $40,000. It's going to be in the middle of one of these years. That's the first step. And then second, how far into that year do I need to get? So here's what we do. So cumulatively, if I invest $40,000, at the end of year 1, I will have $10,000 as a return, just that first year. At the end of year 2, I will have gotten another 25, so in the first 2 years, I will have gotten to 35,000 for the first 2 years. Well, I'm not there yet. End of the third year, I will have gotten another 30. That puts me at 65,000. Oh, well, that's where we cross over. That's where we cross over, because I wasn't there yet at the beginning of the third year, but I was over it at the end of the third year. So I do cross over and get my 40,000. I hit 40,000 somewhere in this third year. So that's the first step. 1, I know it's in that year. Second, how far into this year do I need to get? How far into the year? Well, by the end of the second year, I had received 35,000. How much more did I need? I needed 5,000 more. I need to get 5,000 of the third year's 30,000. Again, I need 5,000 more of this 30,000 in the third year. What percentage is that? 5,000 divided by 30,000 is 0.17. So I need to get 17% into this year. So what's my payback period? It's 2.17 years. Very common mistake is because we know it's in the third year to say, oh, it's 3.17. No, it's in the third year, so I need the first year, the second year, and just a portion of that third year. So you can see it's just a little bit more difficult. We're working the same way. How far do I need to go? And we know we cross over somewhere, and we just need to calculate that out. Let's do another one just to give us some practice, make sure we know how this works. Initial investment, $25,000. 25,000. oh, let me go 7, 11, 14, and then it'll fizzle out 5. What's my cash payback period? Well, it's uneven. So I know at the end of the first year, I'm at 7,000, not there yet. End of the second year, I'm up to 18, not there yet. 18. End of the third year, I'm at 32. So we cross over in here somewhere. So I need to know, first of all, my cash, I need to know how far into this year do I need to get? Just how much of this $14,000 do I need? I need $7,000 of it, because by the first 2 years I've got 18 back already. I'm trying to find out when do I hit 25? When do I have all of my 25,000 back? So I need another $7,000 of this 14,000. That comes out to 0.5. Oh yeah, I need half of this year. So the payback period is 2.5 years. Pretty simple computation. And it really just measures risk. The longer I have to wait until I get my entire initial investment back, the riskier it is. Now, what are some of the pros and cons of this particular method? Without stopping the video, I'm just going to jump back up here, go back to the textbook. Here's where they're doing the uneven flows, and they're doing it horizontally where I was doing it vertically. Yeah, evaluating. It has 2 strengths. One, it uses cash flows, because that's really what we're talking about when we're talking about profitability of a project. When it's all said and done and the project's all over with, am I going to have more money in the bank than when I started? So it works with cash flows, and one of its other advantages is that it is very easy to use. The weaknesses, though, and these are pretty serious weaknesses. One, it does not reflect the timing differences of cash flows within a payback period, and I'm going to illustrate that in a second. It ignores all cash flows after the point. All I want to know is where's the point when I get paid back, and it ignores everything after that. And it also ignores the time value of money, which kind of goes back to the first one. So what does that mean? Okay, let's go back to this. It said it ignores the cash flow, ignores the timing of the cash flow. So if I have 2 projects, Project A and Project B, and I can invest in one or the other. If I say, let me see, let me set this up so it comes out right. Okay, I've got this set up. I've got 2 projects, and they're both going to cost me $60,000. Here's the cash flow on the first one. We're going to get $50,000 in the first year, nothing in the second, nothing in the third, $10,000 in the fourth, and $70,000 in the fifth. Second one, same investment, going to get $10,000 first year, nothing in the second, nothing in the third, $50,000 in the fourth, and $70,000 in the fifth. Okay, so what's the cash payback period? Well, uneven cash flows, so I have to just work it out, and you can probably see it already where at the end of the first year it's 50, and then I'm still at 50, still at 50. Oh, it's 60,000. So it looks like the cash payback period is exactly 4 years. How about the second project? 10,000 the first year, nothing, nothing, 50. Oh, looks like the cash payback period in this one is exactly 4 years. So they both have the same cash payback period. And what the first weakness said is it does not reflect the timing of the cash flows in the cash payback period. Well, which one, even though they both cost the same amount of money and they both have the same cash payback period, which one is less risky and therefore more attractive to me? Well, Of course, the first one is because I get back most of my money in the first year. So I've got back 5/6 of my investment, and I just have to wait a while to get my last 10 for a total of 4. But the second one, I only get 10 up front, and I have to wait. And if you have to wait 4 years, a lot can happen in 4 years. This is more risky. So that's the first drawback of the cash payback period, is that it just calculates, it just goes out and finds the period of time. It doesn't address the timing of them and where they're actually taking place, because of course it's much less risky if more of it's up front, up here, and less of it's later on. Now the second drawback of the cash payback period is it ignores everything. It ignores the cash flows after the payback period. It simply wants to know what is the payback period. So if I have a project here that's going to cost $20,000, and the cash payback is, I'll say, 10, no, don't do that. I'm going to say it's 5, 10, 15, 10, and then I want to say 200,000 in the 5th year. So you can see this is a pretty highly profitable project. The big money's coming in the 5th year. What's the cash payback period? What's the payback period? Uneven cash flows. Now, if we have a steadfast rule that in this company that we do not consider projects that have a payback period of longer than 2 years. We just don't do it. That's our rule. Well, the cash payback period here is, well, in the first year I'm at 5, got my 5,000 back. By the second year I'm at 15, both of those 15, and the third year I'm at 30. Oh, okay, so it's in here somewhere. I need from the end of the second year, I need 10,000 more. No, 5,000. $20,000 investment. I need 5,000 more. I need 5,000 of the third year's 15,000. So what percentage into that year do I need to get? It's 33%. So the cash payback period is 1, 2, and a third years. So cash payback period simply measures this. Cash payback period. Remember what we said our rule was? It's got to be at least 2 years. We would decline this project. But what about this? Doesn't that make it a little bit more attractive? And the answer is absolutely. Absolutely it does. So if we hang our hat on simply using this one method, the cash payback period, we're going to ignore everything after that. So this payback method is not the only method we would want to use. This method is used more as a screening method, perhaps. Perhaps I've got a plot of land and I can do 40 different things with it, and I've got 40 different proposals. And maybe I don't want to evaluate 40 different proposals, so I'm just going to say, well, I'm only going to evaluate those proposals that have a payback period of 3 years or less. And that may wipe out 25 of them, and then I will concentrate on the remaining 15. So the payback method here is really used as a screening method to identify those projects that have the lesser amount of risk to which to apply some other methods to as well. Okay, now the second non-present value method that we're going to look at is something called the accounting rate of return. The accounting rate of return, and it has to do with the accounting net income. We're going to be looking at the net income of the project each year and over the life of the project, and determine what was my rate of return on this project. So we're going to need to set this up, and we're going to need to talk about depreciation and straight line depreciation. So let me set this up and illustrate how the accounting rate of return works. Okay, here's our project. We're looking at this. We've got an initial investment of $100,000. Looks like it's going to provide cash flows of $25,000 each and every year for 4 years, at which point, whatever this project is, then it's got a salvage value. SV is salvage value. I'll be able to sell whatever this thing was for $20,000. So initially, let's talk about the payback period. Hey, this is an annuity. How long do I have to wait before I get my money back? Well, because this is an annuity, I can simply say, well, at $25,000 a year, initial investment divided by 25,000, 4 years. Payback period is 4 years. And that may be acceptable for a company, that may not. But if it's acceptable, then let's see what the accounting rate of return on this is. So the first thing I want to do is simply say this. Well, I'll come back to that. I don't want to confuse the subject matter. So what I want to do is I know, now this is strictly cash flows. Let's make sure we got this down. I'm going to invest $100,000 into we'll say maybe it's a delivery truck. And this delivery truck I'm going to use to generate revenues. And those revenues, I'll be able to make deliveries and collect $25,000 every year for 5 years. At which point, I'm going to sell the delivery truck, and it's going to be worth $20,000. So I want to calculate out what is my net income each and every year. What is my net income? And net income is the revenues minus its expenses. If we have expenses, I'm just saying that the net is $25,000, but that's my revenues. But I need to calculate depreciation. Remember, depreciation is it's an expense. We have to depreciate those assets that we're burning up in our business. If this is a delivery truck, well, this delivery truck, I'm buying it for $100,000. I'm not going to get $100,000 back when I'm done with it, so I need to depreciate it. And we're going to use straight line depreciation, which means the same amount every year. So what is depreciation? Now, straight line depreciation, the formula is cost minus salvage value divided by its life in years. So what was its cost? Its cost was $100,000. I'm going to use it for 5 years, at which point I'll get back $20,000. So how much of this, what's this delivery truck, how much am I going to burn up? What am I going to depreciate? $80,000. And I want to depreciate that over 5 years. That comes out to be $16,000 per year. Okay, let's make sure we've got that. Buying it for $100,000, going to use it for 5 years, at which point it'll be worth $20,000 to me. I'm going to sell it for $20,000. So I'm going to burn up $80,000 over 5 years, over that 5-year period of time. That's $16,000 per year. So that's my depreciation. So what's my net income every single year? Looks like it's $9,000. That's my net income every year, $9,000. Now, I don't think the book does this, but I just want to prove to you that this is a correct number, because if on an accounting calculated using depreciation and using the accounting methods that we've learned in 4A and 4B, it's going to show my income statement is going to show a grand total of $45,000 of net income, $9,000 per year. And is that how much cash I should end up with when it's all said and done? Well, let's find out. I'm going to invest $100,000, and what am I supposed to get back? 25, 50, 75, 100, 125, and the salvage value, 145. So I should get back 145,000 by investing 100. 45,000. So it does work. It does in fact work. Now, what's my accounting rate of return? The accounting rate of return is simply computed by it's the average annual net income, the average net income per year, divided by my average investment. Average net income divided by average investment. So now, what is my average net income? My average net income is, it's the income over the life of the project divided by the number of years. Well, 45,000 divided by 5 years is 9,000. You can see if it's 9,000 each and every year, then the average per year is 9,000. The next one we do, we'll do one where it's not even annuity. But yeah, my average net income per year is 9,000. So I will be getting $9,000 or earning. I will have net income of $9,000 per year on what is my average investment? Well, the average investment is it's starting off at $100,000. I'm using an asset that I'm buying and that is worth $100,000, and I'm going to burn that thing down. And when it's finally said and done, I'm using an asset that's only worth $20,000. So I want to know, what is the midpoint between the initial investment and what I'm going to burn it down to? What is the midpoint between those two? And there's a really simple way, and it's hard for me to wrap my mind around, but it works every single time. If you want to know the midpoint between 100,000 and 20,000, add them together and divide by 2. 100,000 plus 20,000 is 120,000. Divided by 2 is 60,000. Yeah, 60,000 is the midpoint. It's 40,000 from 100, and it's 40,000 from 20. Isn't that interesting? Take the initial investment plus the salvage value and divide by 2. 60,000. So what is my accounting rate of return? 9,000 divided by 60,000 looks like it's a 15% rate of return. Is that good or bad? Well, if we have several projects that we're going to be evaluating, let's see how the other projects are going to come out. And 15% doesn't sound bad to me, actually. I mean, it's better than leaving that $100,000 in the bank at earning 0.5% interest per year. This has a return of 15% per year. Pretty cool, pretty cool. I'm going to set up another one here real quick. Okay, I've set another one up here. We've got an initial investment of $200,000. We've got a $30,000, or I'm sorry, this is our cash flows. We're going to get $30,000 the first year, $70,000 second, $110,000 third, $60,000, $40,000, $30,000. At which point, now this is going to have a 6-year run. At which point, whatever it is that I'm investing in for $200,000, I'll be able to sell it for $50,000. So, just for kicks, let's calculate quickly the payback period. How long do I wait before I get my $200,000? Well, year 1 is 30. By year 2, I'm at 100, and at year 3, I'm at 210. Oh, okay. Well, from this point I only need 100,000, so I need 100,000 of that 110, most of it. So if 100,000 divided by 110,000 is 90%. Let's see. It's about 91%. So I need about 91% of this third year's revenue. So the payback period is 2.91 years. I need 100,000 of that 110. So 2.91 years. Cash payback. Okay, so now let's calculate the accounting rate of return. Accounting rate of return, I need to subtract off depreciation using the straight line method. That's all we're going to be using to arrive at net income each and every year. Straight line depreciation will be cost minus salvage value. How much of this asset am I going to burn up, divided by the period of time that I'm going to burn it up. Well, I'm buying it for $200,000. It's going to be worth $50,000 when I'm done, so I'm going to burn up $150,000 of that asset. The asset's going to depreciate $150,000 over the 6-year period I'm using it. That's $25,000 per year. So, straight line depreciation takes the $25,000 every year. So what will my net income be then? Well, in the first year, it looks like I'm going to make $5,000. The second year looks like I'm going to make make sure I don't do the numbers wrong, 45,000, 70 minus the 25. Third year looks like I'm going to make 85,000. Then it's going to start dropping back down again. Looks like 35,000. Looks like 15,000, 40,000 minus 25, and then finally the last year, 30,000 minus the 25 is 5. So those are going to be my net incomes. What's my accounting rate of return? I need the average net income, X with a bar is average, divided by my average investment. Well, what's my average net income? Well, what's my total net income? Add them up. 5 plus 45 plus 85 plus 35 plus 15 plus 5. These all added up is 190,000. Divided by those 6 years, looks like my average net income is 31,666. It's just these added up and divided by 6. Even if one of these becomes negative, well, you subtract it. This is minus that, and then divide it by 6. Yeah, throw it in there. So on the average, my average net income per year will be 31,666. What's my average investment? What's the midpoint between the 200,000 starting point and the 50,000 I'm going to get back? Well, add them together, divide by 2. 200 plus 50 is 250, divided by 2 is the average investment is 125,000. Looks like a rate of return of 25.3%. That is the accounting rate of return. So we just want to be comfortable with being able to, we start with the same cash flows. We can calculate the payback period. Calculate depreciation. It's just the cost minus salvage value. This may even be 0. Divided by the number of years. That's your depreciation every year. Calculate net income. Average out your net income. Divide by your average investment. And that's your accounting rate of return. Let's see what the text has to say about this. Okay, it's a pretty good evaluation tool. It does say it has 3 weaknesses. It ignores the time value of money, which most of us don't know what that is yet. We'll talk about that. It focuses on income, not cash flows. I don't know that that's a weakness so much. I mean, focusing on net income is not necessarily a bad thing. And income does vary. In this last example we saw, it's not the same. Net income wasn't the same every year. It does vary from year to year. So it's desirable in some years and maybe not desirable in others. But all in all, I think that this is a pretty good return. It does say because of these limitations, though, we should never use the accounting rate of return as the only consideration. We should apply another method. Why not? Let's apply several methods and see how they actually come out. Okay. Now, the next section here, we're going to talk about methods, and it's really just one method with a couple supplements to it, how to interpret it and how to evaluate it. But I'm going to make that'll be the next video coming up, the time value of money. And that's going to take a little bit of time to discuss the time value of money and to get a little familiar with the tables that we're going to be using. So with that, I'm going to sign off on this video right now, and I will load the next video hopefully tomorrow morning when we'll get it loaded, and they'll both be here by the time you look at them. So anyway, stay safe, stay cool, and I'll be in touch with the next video.